Are you recording?
Hi, I'm Curtis,
And I'm Dayan.
and welcome back to the SMS.
SMS.
Okay, let's get it. Hi, I'm Curtis,
And I'm Dayan.
and welcome back to the SMC series on the YouTube channel. So today we're basically covering chapter 4. We've covered all 3 chapters so far: liquidity, market structure. So those were the first 3 chapters. Today we are covering supply and demand, which some might argue, like I just told Dayan, is the biggest chapter in, also second biggest chapter in the SMC strategy, because it's quite a lengthy chapter we're going to cover in today. So if you're new, I think you all know what to do.
Like,
And
subscribe, share, all those other things.
Yes. So let's not waste any more time and let's get into the chapter. So it might be a very lengthy. So get your pens, get a snack perhaps, and let's get into it.
Chapter 4. Supply and demand. What is the supply and demand? Okay. From an economic side, this is the relationship between the quantity of a commodity, the producers that produces. What? The fuck is going on with my head?
I know it was me. It was me this time, bro.
That producers wish to sell. See,
I
that's
think
what
this is the book that gets us like this, yeah.
The producers wish to sell at various prices, which I guess, and the quantity that consumers wish to buy is the main model of price determination used in economic theory. Wow.
Explanation of a semantic step-by-step demand curve. So basically this is just a small semantic of a supply and demand, basically. Schematic. Semantic. So as we can see, there's a quantity and this is the price. So this is just your demand curve is basically going down. I'm not sure exactly what these figures are yet on the side. 40, 30, 20. So I'm assuming this is the quantity and this is basically the quantity and the price. Okay, I get it. So as we can see here, we have a chart which represents the quantity versus the price. We will start by analyzing the demand curve. This one here decreasing, that means that when price is high, my demand will be low, and if the price is low, then demand will be high. Everyone wants to buy when it's cheap, and no one wants to buy when it's expensive, basically.
Premium price.
Premium price. So I think you can make your own assumptions, basically, your own analysis of what this basically means. So here's just a supply curve. This is a demand curve. This is a supply curve, as we can see here. So it's basically the opposite of what we just said right here. So here we can see this is the price, and this is basically the quantity of it. So
the supply curve is increasing. That means that for a low price, the supply will be low, and when the price increases, the supply will increase with it. It can be explained by the enterprises.
Yeah.
They want to make the profit, and when the price increases, they are ready to offer more and more.
Okay. So that is just basically like a theory, or like the interdelivery to supply and demand. So just a more semantic of it. So here we can see the equilibrium we've covered. Like I think we've mentioned these terms in the past. Equilibrium is basically just your middle between supply and demand, where
supply and demand is basically.
Yeah. So the cross between, I think we're gonna the equilibrium. Yeah. The crossing between supply and demand will offer the enterprises the equilibrium price and the equilibrium quantity. This is the most profitable way for enterprises not to lose money as much as possible. They sell the best quantity at the best price. It's important to understand the economic side between supply and demand before trading. Understand what to do is the best way to do it well. Okay, to do. Trading perspective. The demand bias curve shows that for a high price, the quantity will be low. On trading, we can apply that to the bullish trend. When the price has made it a big move to the upside and starts the pullback, that because the price increase and the demand decreases at the same time. Price will need to rebalance the price to increase the demand.
Take 2. The supply sellers curve shows that for a high price, the quantity will be high, where we can apply that to a bearish trend. When the price is high, the supply is high, and the sellers take advantage. At a certain level, the price is too low and the supply decreases with it. Price will need to rebalance the price to increase the supply.
Okay.
See, there's a tongue twister saying price so many times.
Yes, it is, definitely. So the supply and demand zone. S&D zones are simply big moves where a lot of orders are sitting. So that is also like a more of a liquidity, since liquidity also fit into the spot. So generally the zones are placed near the protected structures, yes. So we need to understand how is moving the price, how the price is moving. Come on, Order. As we know, okay, I was fucking so my peripherals there. So as we know, it uses the liquidity to fuel the movement. With the supply and demand concept, we can go deeper into understanding of the price. In fact, price is moving from supply to demand to rebalance the price. Okay. In a bullish market, we will look for the demand zone to see where price could bump. The demand zone will generally be just before a protected low, okay? As it's very bullish. We want to buy demand at the lowest price possible to make the best outcome. Okay, that's a important part. In a bearish market, we will look for supply zone to see where price could bump also. So it's basically the opposite of what we just said on top. The supply zone will generally be just before the protected high, yes, as it is in a bullish market. We want to see supply at the highest price possible to make the best outcome. So exactly just the opposite as we saw so far, supply and demand. So how to spot? So here we're getting into a little bit more of a graphical since there's been a lot of like theory.
How to spot supply and demand.
Yeah.
Supply and demand zone can be spot on the market by a big move with a lot of momentum that breaks the market structure. So break the structure. The zone is generally accumulation before the bump. In those, what the fuck is happening today before the bump accumulated? Okay. In those accumulations, there are a lot of liquidity generated, and once price comes back, it uses the liquidity pool to create a move with a lot of momentum.
Demand zone.
Yes.
So we can see here, there's the break of structure, basically this liquidity pool, and it creates a demand zone since here. This movement right there, the imbalance, what we've covered in the past. So there we go.
And then your order block
would be right there. Yeah. As we said earlier, in a bullish market, we will look for the demand zone to see where price could bump. So it's not necessarily that it will bump, basically where it could bump. The demand zone will generally just be before a protected low, yes. This is where we can sweep the most of the sell side liquidity and where we'll fill the most imbalance. Okay, so this here and then sell side liquidity, which is right here. So as we can go, so this is just a chart example of that, the demand zone. As we can see there's a break of structure, there is an imbalance, and basically that's sell side liquidity, as we can see right here, which generally creates a demand zone right here.
So and
it's generally just before a protected low, like they mentioned at the bottom, and here we can see here's a protected low right here. So that's how to spot the demand.
Another name for imbalance would probably be a fair value gap.
Fair value, not necessarily, because fair value gap is this here also. This is an imbalance could be a fair value gap.
That's what I'm saying. Price or increased rapidly or decreased rapidly, and there's a gap.
A gap basically. Okay, so as we can see here on the chart, doesn't come back to the protected low. We could have a zone there. We could have a zone there too, but price reacts to the one above. Okay, so basically this could also be a demand zone, like you mentioned, but the one price reacts to the one above. So zone selection. So these are the author's 4 personal rules for spotting a demand zone. So basically, the first rule is identifying a break of market structure. So basically a BOS, which is this one here. And the second rule is a momentum in the BOS. So there's momentum basically, so which is this here. So the third rule is liquidity. So there's liquidity right here. As you can see, there's because of the imbalance. And his fourth rule is because of the imbalance. So this is these 4 rules for like identifying a demand zone. So you can write this down, maybe to a few, like have it noted down and just try to memorize it. So on to the next part, supply zone. So supply zone is basically just what we said on top, the opposite of the demand zone, which is on a downtrend. So the supply zone on a bearish market. So it's basically the exact same. How to identify: you have your break of structure, you have your imbalance, and you have your liquidity or build up to liquidity, which is right here, which will identify a supply zone, which is this right here. I'm assuming, as we said earlier. Okay.
I was gonna read it.
I'm in the zone.
I see you flowing. As we said earlier, in a bearish market, we will look for supply zone to see where price could bump. The supply zone will generally be just before the protected high. This is the place where we sweep the most of the sell side liquidity and where we will fill the most imbalance.
That's Gucci. Short example of what we just said. Like you can see, there's the imbalance, protected high. So there we just have your sell side liquidity. So this one could protect it high, and this is your swing low, break of structure momentum, which falls to your liquidity side, and then
I would say this is also a chapter you should really pay attention to. Like you should really go through or like really rewatch on your own time, because 9 times out of 10 I'm using this type of method when trading. I'm looking for the imbalances and all of that.
Yeah,
it is really important.
I think, like I said, we said at the start, is like I would say you can argue it's like liquidity and demand zone, supply and demand is like the 2 biggest chapters in SMC or trading as a whole, because you will see a lot of videos online with supply and demand and liquidity. That's the most like topics, even if it's not related to SMC, you'll basically apply to any type of other strategy, which is these 2. So what is an order block? Order block.
Yes.
It's good to know what supply and demand is indeed, but this can refine, and this is where an order block will be introduced. So basically supply and demand is order block is a refined supply and demand. So it's basically just building onto what we know.
It's more in depth.
In depth, yeah. So order blocks are simply the most refined places of supply or demand. As we know, supply and demand are big liquidity pools where a lot of orders are seated. Sated. We are able to refine the supply and demand to the last candle before the bump or drop of the price. Okay. So order blocks will allow to form more imbalances and to increase your risk reward at the same time. One thing you need to understand is that sometimes price reacts directly to a supply and demand zone instead of the order block, and you cannot predict it, unfortunately. You need to do this to test what is the best for you, basically. So this is where trial and error comes in, and basically just having time experimenting with these types of terms.
Yes.
So order blocks, as we can see. So this is basically an order block. Here you have your supply and demand. So this is where you could identify a order block. Yeah. So this is here as an example. These are just examples. So basically, when you do it or back test,
And like just like maybe 5 pips below would be maybe your stop loss.
Stop loss, yeah, 100%. So this, we don't have an example now. So this could be a 2 to 1, and then basically here's your 1, and then your 2 is here as an example. Okay.
Order blocks can also be named point of interest (POI) or area of interest (AOI). At the end, that are just some fancy terms to say the same thing. On social media, many mentors use different names, and you can be lost.
Yeah, depending on the strategy. So SMC, we just use order blocks, but for example, a trend line trader might just say point of interest, but that's the same thing, guys. So this is just your chart example of an order block. As you can see here, you have your sell side liquidity, your break of structure, swing high, and then your order block is right here.
The order blocks has several advantages. You can
Write this
refine
down.
your entry and increase your RR, which is
Return to reward.
Risk reward, yeah, risk reward. I can't say it. You are not the liquidity. Whew. Listen here. You do not want to do liquidity.
Yes.
You form maximum imbalances. You sweep all the liquidity. It creates big moves. We have different kinds of order blocks that can be seen on the market.
Yeah.
The complete candle, the sell to buy, and the buy to sell. The other candles, the sweep and shift, and extreme and decisional.
Yes. So the complete candle. So basically these are, I think this is where you'll have like to write it down and memorize, because even if you do look at it now, I think most of us will forget how this will look. So the complete candle is basically one green candle or opposite of a red candle, and then we have a big wick of the opposite candle, for example. So that is how to identify an order block. So
it's like an engulfing candle.
It's like, yeah, it's basically like really like an engulfing, as we can see here in the opposite. Yeah. So I think it's engulfing. That's engulfing, 100%. So as you can see, there's a 50%. Basically, here's your activity or movement in the market. This is the opposite, and then you identify your order block. Here's the author's word on this. When the OB order block is a candle, price will generally trace to the 50% of the candle. In fact, in this complete candle, we have enough imbalance. This can be visible on a lower time frame. Most of the time, price will need to fill the imbalance. Okay, so that's core. This right here is core. So as we go on, so this is the first part of your type of order blocks. Here we have the second one. So this is theory, where I think which after this video maybe have memorized the 5 types of order blocks. memorize the 5 steps you need to identify order block, and yeah, that's basically a test for yourself afterwards. So the sell to buy, which is the S to B candle. So this is the different type of candle. So here we have the, I don't think we've covered like the engulfing when we did that engulfing one, because this is when we did engulfing, we didn't do the sell to buy. So that's basically where a sell to buy candle looks like. So we have a middle wick and we have another wick. So basically this is two uptrend, basically two green wicks in the market. So you can see there it's a higher time frame. This is identified in a higher time frame, and this basically there's already is your order block. On a lower time frame it looks like this, as you can see there. Let me just zoom in this. So on a lower time frame it looks like this, and then we can identify order block right
and
here.
this that whole section is just one whole candle.
Or one candle. This 2 years, this basically this at the bottom.
On the sell to buy candle, we can see a big wick to the downside. This wick can be used as an order block. Why? If you go into a lower time frame, this wick will be a structure that can be used to spot a nice order block, and we know to find an order block, the first rule must be to have a break in the market structure. Fuck me and my English. Generally, on a higher time frame, price will create a wick and will come back fast on the POI, point of interest. On the LTF, we will see a structure that has been broken. LTF mean lower time frame.
Lower time frame, lovely. Get the jargon, guys, get the jargon. So this is your chart form of what we just have, your sell to buy, identifying order block. So we have two, which is your on top, which is the complete candle, and then now we have our second one, which is the sell to buy candle. And here we can see this on chart form. So there we can see the sell to buy. Here we have this, and then we have our two candles here, which is identified like this here, as we can see, which is this here. Lovely.
Lovely.
So yeah, we have our sell to buy. This is our sell to buy. Okay, this is on the lower time frame. Okay, away. So they're giving the higher time frame and the lower time frame, as we can see here. And there we can now identify our. They just look at the spot here again, the 1, 2, and coffee, and there we have it again. Okay. Just make sure.
Your 15-minute and your 4-hour time frames.
Yeah, 15. Now I think that's most like the book is just covering those, like the 4 hour as the swing was, and the 15 as the internal. On the lower time frame, we can see that price creates a structure and makes a breakout structure with momentum that can be used as a order block. So this is on the lower time frame. So here's our breakout structure, and there we go, our order block. Okay. So the buy to sell candle, so it's basically the opposite of the sell to buy to sell. So it's basically the exact same you saw now, just basically going downwards. So you can see there's the higher time frame, and here's our lower time frame, how to identify order blocks. On the buy to sell candle, we can see there's a big wick to the upside, which is this right here. The wick can be used as a OB. Why? If you go on a lower time frame, the wick will be structure that can be used to spot a nice order block. And as we know, to find a order block, the first rule must be identify breakout structure, like exactly what you just said in reverse.
Yes.
So we can see there. Generally on the higher time frame, price will create a wick and will come back fast to the point of interest. Lower time frame will create structure that has been broken. So exactly the opposite. So yeah, once again on a chart form, it basically just shows you how it looks. There we can identify order block right there, buy to sell. So basically, if this applies to both, if you see the first one and second one, then you know it's like a strong OB. If you can see the first type of order block and second type of order block, then you know like it's giving you both signs that this is a confirmed order block basically. So the other candles there we can just see on the chart form basically the exact same. Gives us that structure there. Few chart examples. So here's just a few chart examples. So I think this is where you can pause the video and look at it, but we'll zoom in for you guys, so don't worry.
Yes.
I think that's enough of a zoom.
That's enough of a zoom.
Here we got imbalance. Here we can see breakout structure. That's the first part to identify there's a breakout structure, the momentum. There we got our liquidity, and then confirm swing low. Okay. There's just more examples of order blocks. Here we can see there's 1, 2 breakout structure, because that's 2. We can see order block is basically confirmed after breakout structure. That's one of the rules to identify. If you see an imbalance, then you know it's too thick basically. Yeah, and then liquidity, like that 4 rules we mentioned. So this is another one to identify.
The sweep and shift.
Yeah.
Yes. I taught you different kinds of order blocks, which he did.
Not us.
Sweep and shift will work either on a complete zone as a SND and also the OB order block. The sweep and shift consists to sweep and
the sweep
The sweep and shift consists to see a sweep of liquidity and then a break in the market structure. Before the model, we need to clearly understand what is sweep of liquidity. The sweep of liquidity is simply a grab below a low or a high, depending on the structure. This induces people to make the wrong move and generate liquidity.
Yeah, so the basic sweep.
Right, this
This is similar to what I told you, like what we're gonna cover in the book, where it's like a fake market structure or fake zone. I think we covered this.
Fall zone.
Fall zone, yeah. So here we have a sweep. Basically, as you can see, there's a sweep and it goes up. There's a stop. So that theory wise. As you can see on a bullish market on the left, we sweep the protected low, which is here. The sweep induces sellers to sell and will create a zone to trade for SMC traders and to sell the market. Vice versa on a bearish market, price sweeps the protected high, as is on top, sweeps the protected high and induce buyers to enter on the market. Yep. So basically tricks. So people will see there's a break. But remember what we said, to make sure it's a change of character, it needs to break 2 points, which is what we covered in chapter 2 still, where it shows us there's a full change of character. So basically it takes out the protected low, and for basically to make sure there's a full reversal in these two, come basically take out this, then you know. Then at that point we will say basically enter. Because now you know the first point is confirmed, wait for the second point to be confirmed, then now we can say that's a full change of character. So let's just go on, the switch and shift, more examples of it. So you can see here, break of structure, basically there's 2 sweeps in one. Yeah. I can see there's a sweep at the bottom, the sweep at the top. So you can see there we have our sweep, basically this is the order block, sweep basically the sellers, comes on top, sweep the buyers. Because he told it we broke off the sweep here. There we go. Here's it. After the sweep, we want to see the price break the structure. This will create a clear powerful zone, and we added the previous rule we saw earlier. We can increase more and more our probabilities basically. Yes. So yes, once again I'll zoom in, visualize it, write it down, draw it out, do the most. Yeah. We can come back to this.
Yeah.
The fun thing about it.
Yeah. I feel like my glasses are not working.
Is it? Like it's for me it's also a little bit. Okay, the sweep and shift chart example. So once again, this is a chart example. I'll do the honors by zooming in for you guys. As we can see there, the image. Here we have a sweep, we have a break of structure, here we have a sell side liquidity. This is identifying our order block. This is where you'll have your 1 to 2 trade, 1 to 3 trade, or 1 to 5 trade, and basically take the trade from here. And this is your sweep right here. So this is the core part about it, to make sure sweeps out all sellers. As we follow example, I think you got this.
Okay. On the following example, we get a big sweep of liquidity that is very visible. You can also, it's visible, yes. You can also see more difficult sweeps like the example below. Zone selection.
Zone selection, yeah.
We add previous rules for zone selection. With the sweep of liquidity, we can add a new rule to our zone selection.
Okay, so there's a sweep. Now I think this is the sweep break of structure. 1, 2, 3.
Yeah, I was reading very clearly there and I had no glasses on.
So these are the rules we can add on to it. So we identified 4 in the previous one, but now we're just adding another one. So to identify a strong order block, it's basically the one we've mentioned. We have break of structure, momentum in the break of structure, liquidity imbalance. But now we're adding the sweep. So if you see a sweep also, that means it's a very strong type of order block. So you know if you can see all 5 when identifying order block, you know it's a strong order block. So it basically increases your chances of probabilities quite high. We will add another rule before showing the rule following. So we will add another one onto this 5 rules. Right? So there's going to be 6 rules for identifying an order block. Let's introduce the inducement. So the inducement.
What is
inducement?
Basically, inducement will be liquidity.
Okay.
Many mentors use the same term for inducement and liquidity. Okay. Inducement is more likely the liquidity that happens before a zone. This is where people will get induced and create more liquidity for the zone.
100%. So here we can see we have our BOS, we have our sell side liquidity, here we have a consolidation, here we have an inducement, which is what we just said here on top, manipulation, which is the spot here, and then basically this identifies a strong order block at this point because we have a break of structure. We have the liquidity pool right here. We can't identify the other ones we've mentioned, how to sell to buy, because this is just a line example. But if we see it on a chart, we could add that also as identifying a strong order block. So that is just introducing the inducement onto this. So as we can see, as you can see in the retracement phase, price comes back to the buy side liquidity. There are possible zones to spot with PO stocks, momentum and other rules, but better to keep the one with the best liquidity possibilities. Okay, as we can see, price reacts to the liquidity and generates more liquidity before hitting the order block. Okay, 100%. Let's see. Break of structure, buy side liquidity, what I just said. There's this inducement which generates that more, and then it creates upside liquidity, which is this zone right there. Manipulation is generating liquidity, so there's having a node for us generate inducement, basically just generating liquidity. So it's another term for your buy side, sell side liquidity there. Zone selection add 2. So here we added another part where we identified 5, now we have 6 1. So all what we said so far, we just add the 6th rule, which is inducement. So if you can at least spot 4 out of the 6, I would say it's a strong order block. So powerful for the power of the rule from X to X. Okay, I can get this. Refinement.
The refinement of a point of interest or your order block is looking for a lower time frame point of interest in a higher time frame one. That helps to find where the imbalance is in the higher time frame.
Order block point of interest, yeah. So the higher time frame is here. So refinement. So it's basically just refining the 6 rules we just had. So here we can go. So basically refining is looking across, like at least looking at 2 to 3 time frames, I would say. So you're just refining what you just saw.
I'd say 3 because you would look for, you do your analysis. You'd start your analysis maybe on the 4-hour time frame. You'd go deeper in with your 15-minute, and then maybe on like your minute or your 5-minute, you'd look for your entry points.
Entry points, yeah, 100%. So yeah, we can just see on the 1-hour time frame, there's some words which I cannot see. What the refinement, you can avoid the trap that becomes inducement for the 1-hour time frame. Okay, so it's basically just identifying this here. Here we can see the 1 hour, the 4 hour. Okay, Gucci. Yes, you can pause it and do the most.
The extreme and decisional. The extreme consists in the zone that is just near the protected structure. The decisional will be the zone that was created for the change of character or the break of structure. Yes. And here's the example
of it. Okay, break of structure. So extreme and decisional example. So basically there's 2 possible outcomes of this happening, which is the decisional, and this is basically just your extreme scenario. So the scenario 1 would be touch this, order block goes up, doesn't happen, come test the extreme zone of an order block, because here we can see the break of structure. So both of these ones are basically, both of them are strong like lows.
I'd say that by the extreme that is like maybe your protected low.
Protected low, yeah. Yeah. Because of the first break of structure. This first break of structure make this one more likely. But this one is also confirmed low because it broke off here on top. So this is why it's a decisional, and this one becomes an extreme. I personally use the rules of zone selection to which one I would take. It will change also depending the instrument you are trading. Okay. So depending on the
trading view,
definitely that.
Exynos, them.
IDM, which is a tech company, but now we're using inducement. Chart example. Here we go. So inducement of a chart example. As we can see here, we have a break of structure, which is at the bottom. Here's your inducement, which is manipulation once again. So everything is manipulation. There's banks and financial institutions. All of them manipulate. So here we got
big players,
inducement process which is happening here. So I think we'll just need some more understanding or more explaining this. So the inducement is important to know. If you're waiting for an entry on your zone and price reacts just before it can induce you in a bad decision. I think this had happened to me, and this has definitely happened for me. As fear of missing opportunity and get an early entry. Spot your zone and wait for it no matter what happens. So this is a core part. So when you've spotted and have identified 4 or 5 out the rules, stick to your stick to your zone and don't try to enter the
I think
trade early.
this is basically like where your discipline is tested.
Discipline is this, because you check now, price is going, it's going your way of a trade, but it didn't hit your trade basically because it didn't hit you. So this is where it induces you.
You might try to come in early on a trade and then end up
Going
maybe
up.
losing, or maybe you could have gained more.
Yeah.
Yeah.
Okay, so this is inducement in the opposite. Yes, this is your sell, basically your bearish example, and here's your bullish example. So you have a break of structure, you have a sell side liquidity, and this is where you have your inducement period, which is right here. So smart money traps, this is what I was talking like, I forgot the term smart money traps, yeah. So spot zones are important. Being able to spot the trap could help in filtrations of your zones, so it's filtering out the bad zones. The smart money trap is basically liquidity before the point of interest or order block, but as it's a valid zone, many smart money traders get trapped in those. Okay, so here's basically a smart money trap. So you can see there's sell side liquidity. So basically when you identify this, you could think this is an order block, because basically it has two of the, for example, it has a break of structure, it has the liquidity part to it, but it's basically just here, you can see there, because it still gives you signs of being a order block. So there's your sell side liquidity, a smart money trap, and basically this here on top becomes your order block. Okay, as we can see, the smart money trap is mostly the place where inducement is created before your zone. It's possible that price reacts from a smart money trap and decide to follow it, but we prefer to follow the strict plan that gives us the best possible probabilities in order to get the best edge and to maintain it basically. Okay, here we just have another smart money trap example, a bullish smart money trap example. So here we can see you have your BOS, you have your sell side liquidity, goes up, comes down. Basically when you see this, you can think, because it has 2 points already, so you might assume it might create a third point. Then it comes back to the start of this swing.
Protected low.
Yeah, protected low. So smart money trap chart example, I would like to just do this because you can clearly see it better. Here we can see you have your BOS, sell side liquidity, your smart money trap, which is here, and then here's your actual. So yeah, you might have an entry, but then it just, your stop loss is here. You know, it's always like a 1 above your order block. Then you get stopped out. And that's basically the chapter.
That's it. Yes.
So I think mitigation is the process. So all chapters from here on will be very short, guys, since liquidity and supply and demand is the biggest chapters in this book. And I think this is where you will have to just go back, because I think we fumbled today a little bit.
A little bit?
Just a little bit. We fumbled, we talked fast, but like I said, you have the privilege of going back into the video and making your own notes. So,
and in our defense,
yeah,
the English is not very English.
Yeah, so
in this book.
Yes, we tend to read fast, but also us reading fast makes us making mistakes.
Yeah, there's a lot of tongue twisters today.
100% mistakes. So once again, I hope this video gave you guys of a more insight and you've learned something from chapter 4. And yeah, I think this is where we'll sign out for today. And
if you have learned anything from chapter 4, please check out our previous video on chapter 3.
Yes. Chapter 3 and 4, the most important, so watch it as many times as you can and get it down, throw it out, make your notes and take it from there. So do the liking, do the subscribing, and also if you're looking for a broker, make sure to check out HFM. And yeah, we will see you in the next video. I'm Mr. Curtis04.
And I'm Mr. Peffer.
And we'll spot you again, guys. Peace.